If you are not getting educated about current economic and market conditions, whether you're in title, mortgage, finance, accounting, or obviously real estate, you are doing yourself and your clientele a disservice. This is the Knowledge Brokers Podcast. I'm Tom Toole, and I'm here with Byron Lazine and Lisa Chinatti. And the Fed met this week, guys. They raised rates. Jerome Powell continued to try to bury the housing market. Although mortgage rates reacted a little differently, we saw the 10-year hit that Gandalf line, as Logan Montashami calls it. What are you guys thinking right now? It's Friday morning. The weekend's coming. There's a lot to be talked about.
It's going to be a good one. Some good stuff.
I'd like Lisa's take on it first.
All right. So I actually think the 25-point increase was exactly what was needed. I think 50 would have been too much with everything going on in the banking sector. But I think if they didn't put in any level of increase, I think it would have created more fear and doubt that would have had just as bad a negative impact as raising it by 50 points. So I actually think that the 25, I looked at it as a positive from my side.
Well, you think if they paused, then people would have said, wow, this banking crisis is bigger than we think, because they were, indicating a raise, they're very strong in their, verbiage in that. And now all of a sudden they're going directly to a pause. You think that would have actually incited more fear?
I do. I think it would have sent a message that there was a lot of uncertainty from Powell himself, and maybe even some fear that if he continued down the path that he intended to go down, that he would create even more instability. And I think that that message would have carried through much louder than any other message.
That's a good way to look at it. And yeah, I mean, that's interesting. I mean, certainly I think 3 weeks ago, Tom, I don't know if you remember the numbers. I think we've talked about it here. The market was pricing in that 50 basis point. So to come down to 25 is still an indication that, okay, we're monitoring the situation. But yeah, I guess to your point, we're not going to go all the way to the pause. I wanted to see a pause because I think this banking issue is going to have some legs to it. If you think about Bear Stearns and Lehman, those were 6 months apart. Mm-hmm. So it's not like, okay, Janet Yellen, 97 plus years old, gets out there and says everything is good, and everybody is like, oh, great, everything is good. Janet has spoken. By the way, she flip-flopped all week long. So I think Powell did a better job than she did. But just even today, you see Deutsche Bank shares are down 11%. So, that's a new name in the club here of banking issues. So I think the increased pressure that the Fed, Jerome Powell, continues to put on the economy is going to have rippling effects. And eventually they're going to have to pause. Indications, Tom, are that we're going to see another raise, and probably similar to the 25 basis point that we just saw.
Yeah, the rhetoric coming out from Powell, and if Powell, he does a better job than anybody talking about this, then they've done a horrible job.
He doesn't do terrible.
Well, it means Yellen just did horrible, I think is the point. So that's more my observation. I think the good news here is that the Fed did adjust their original plan, because it was pretty set that it was going to be a 50 basis point increase when we talked a couple weeks ago. The CME Group Fed Watch tool had it pegged at a 73 to 80% chance, varies on the day-to-day basis, obviously. We were going to see 50 basis points, seeing 25. Lisa, I like your take on that, because it was what was expected. I like expected things in economics and housing. I like what's supposed to happen to actually happen, because the market can already price this stuff in. The interesting thing here is, usually when this happens, they raise rates, you see mortgage rates go up. That's not what happened this week. And I mean, we were getting quoted 6 1/8 yesterday. I don't have a read on this today on Friday. That's exciting news for people, because inflation still is an issue. We know that that's their number one target. They're looking at 2%. Affordability for housing's also been an issue. So if that comes down to 6 1/8, I mean, 2 weeks ago, we were north of 7. We've seen a full point drop at this point. So that to me is pretty interesting news. I think it's important news. And most importantly, I think it's going to kind of stabilize the 30-year. If you look at Logan Montashami, I follow this guy on Instagram. I mean, he's a little bit of a nerd, but he calls 3.4 on the 10-year. 3.4, that's the Gandalf line, like thou shalt not pass. And no matter what happens, it's like they get down to 3.4 and it just won't move past there. And if we see movement past there, that's where we could see demand almost explode.
Yeah,
And
you're right.
I mean that would really, I think it might even create more problems in the housing market if we have any more demand than we have now, if inventory stays where it is, which we'll get into. So I like low sixes. I'm positive Pete this morning. I mean, I think it's going to be, and for the home shoppers out there is nothing better than seeing rates come down on a Friday. And I know you guys know why, because you've got certainty over the weekend. You lock in a home, you can lock in that rate, and that gives you certainty on your payments. And that's what a lot of people, in my view, are searching for right now. Certainty in the market.
Or even just stability, right? Like I think that that's the certainty, but knowing that the certainty is going to carry through across different levels. I think some of the stuff that we've been seeing is we get to certainty or stability in one end of it, whether it's mortgage rates or consumer confidence or whatever, and we just create instability in some of the other areas. So finding that across multiple different avenues is going to be really important for all of this to kind of get back to normal.
And so what we need to keep in mind is when the Fed raises this rate, the initial reaction and the initial reaction this week was actually a drop in that 10-year, right? And so, Lisa, to your point about stability, the 10-year has been a little wonky, which has created, up and down in the 30-year. 6.5 is where we're kind of closing this week out at. If we can get to that 3.4 number that Tom's talking about, which is where, as of the, that's where we're at right now, Tom. We're actually right below the 3.4 mark on the 10-year as we're taping this here Friday morning. You can get closer to 6. That's what we've seen throughout the year. It gets closer to 6% when we're at 3.4. But we've just seen too many of these spike up. So don't watch that federal interest rate necessarily. The 10-year dropped after they increased the 25 basis points this week, which brought the 30-year fix back down from 6.75 to 6.5. So we've got to keep our eye on the 10-year. I like where it's heading today. That's for sure.
The interesting thing I found is that it wasn't, the comments after the meeting are always interesting, right? It's like, what's going to happen next? Because that's what people want to know. And it wasn't really, he was more middle of the road than we've seen him in the past. It wasn't that like really hawkish tone that we've seen. And it looks like they're kind of going to let this play out. I mean, they said here that they need more evidence to be convinced that banking sector issues alone can do the disinflationary work for the Federal Reserve, because that's still their main focus. All they're fighting is inflation right now, and it's the fact that it's more middle of the road than it has been. Because 2 weeks ago, I think, Byron, I don't think you were on the show. Lisa and I were talking about it. I mean, Powell was like defiant in front of Congress. He was getting in arguments with senators, and he chilled out a little bit. So,
well, what's your take on his housing comment? And this was in the first 2 minutes of the talk. Quote, Jerome Powell said, "The U.S. housing market remains weak." Lisa, what's your reaction to that? Do you consider the U.S. housing market weak?
Nope. Well, regionally, no, right? I think that there are certain areas where maybe that is the case. And I guess it depends on what you define as weak. Is it weak in that the demand is low? No. But is it weak in the number of listings that we have to keep up with what we need? Yeah. That there is a weakness that exists, but I don't necessarily think it was the weakness he was referring to.
Yeah, NAR just added 580,000 sales to their seasonally adjusted number. What they're from 4 million in January up to 4.58 million in February, in the same week that Powell calls the housing market weak or remaining weak. Tom, what was your take on that quote?
Well, Lisa hit the nail on the head. What do you mean by weak? I mean, it was, it's sometimes these people come out with quotes and they're really vague. That's how people in Washington know how to talk. They're very non-committal. They're flopping around like a dead fish on the side of a boat. The housing market is weak in one factor. People who want to buy can't go buy a house right now. That's a weakness. I mean, because of the inventory challenges that we're seeing. And I do see, and my hope is at the beginning of the week on Housing Wire's housing market tracker, we saw a blip up in inventory by 1,700 units, a little more than that compared to the previous week, where we were seeing previously 6,000 unit declines in available inventory. So if that continues, and that would be the best news for anyone that serves the real estate industry, is just getting a little more inventory, because demand's still going to be strong. Single family residences, people want them. It's that issue of people who want to go out and buy a home. They've gotten pre-approved. They got the money set aside, and they would probably sell their home if they found something, which this is where the logjam is. So it is weak in the ability of buyers to go out and find a home and buy it if they wanted to because of the challenges there. It's not weak in terms of demand. Affordability is historically in a good spot with rates in the sixes. The weakness is the ability for people to transact when they want to.
And transact at an affordable price point.
Sure.
Like, so the new home data that just came out, new homes, new construction's up almost 40% to 440,000 median price point. The median price point, according to NAR this week, came out at 363,000. So that's an 80,000 spread between new home sales. KB Homes earning report, they were at 495,000 for their companies, new construction median home prices. So there's 8 months of supply in new home sales, but they're all well above median price points. So even when we look at the current inventory, you could have, something that's a tear down on the market and then something that's well above median price point. And the middle, like mostly everything in America today, the middle is absolutely dead. And that's where most home shoppers exist today.
That's the brutal part. And looking at what skew that's creating in average prices and some of the perception is becoming tough. I was running some numbers before, just looking at very small pockets within Massachusetts, and a lot of it is created by some new construction sitting on the home at average prices that are sitting at about $1.4 million is the average price for new construction sitting on the market in Massachusetts today. If you take that out of the equation, the average price of what exists is hovering around 500,000. But when you put that in, it drives up the average price a good chunk. It's bananas.
Has the new construction slowed in Boston, Lisa? Because I know you follow Boston closely. The last couple of years, it seems like there's just cranes everywhere, whether it's South Boston or really all over the city. Has that slowed down?
No, it hasn't really. And that's the ironic part, is that there was some fallout when rates jumped up a little bit in the fall, or when the rates jumped up a lot in the fall. There was some fallout with some of the newer developments that had sold out, but where they didn't allow financing contingencies, and the affordability changed dramatically for some folks who had been on the cusp. But we've found that almost all of those units have actually been resold. And so the new construction, it's not so much South Boston, the Seaport area is just like skyscraper after skyscraper coming up, and both a mix of office space and residential space, which I find fascinating.
Oh, Powell was asked about office space, and it was interesting. They're like, hey, is that the next banking crisis? These banks that deal with, a lot of commercial loans where they've got commercial investors, SVB was a lot of tech, VCs and tech investors that were holding their funds at SVB. And so they're like asking about regional banks that deal with mostly commercial lending, specifically offices. And he had a very short answer. He's like, these banks are, diversified and they're very liquid. He wanted to continue to instill confidence in the banking sector. I was listening to a guy from one of these funds, Barry, his name's escaping me. I'll find it here in a second. Anyways, he said new office buildings, so that like the new construction office buildings in Boston, for example, are very strong and tend to be, leased out. And then these older office buildings are the ones that are very vulnerable.
Yes, I agree with that 100%. Even in the suburbs of Massachusetts, we're finding the same thing.
We had, our office here, Lisa, you've been here. I mean, every tenant has moved out except us and the owner. That's just the building's no longer fully occupied. And I mean, it's a anecdotal instance, but you've been. It's not like an old building that we're in. So
that was Barry Sternlight from Starwood Capital Group, just for reference there. Who I was trying to remember. Tom.
You could have just left him as Barry, and I think that would have been good.
Well, it could have been
Barry Bonds.
It could have been that guy Barry Habib, the mortgage guy. There isn't that the mortgage guy?
It is the mortgage guy. He has an interesting prediction about rates. We can certainly unpack that. I'd have to look it up here. Office space. I mean, when we saw the SVB and Signature Bank failures, buying Byron has opted out of this group text, Lisa, but you were on there, and we had some good inside intel that commercial was one of the more risky areas. Single family residence is really strong, but that's what a couple very high up people said at large companies, big banks. But we're not going to go into where they are. So that is a very real fear. And when you think about, look, when there's recessions, people are looking to cut costs. I mean, we've all had this conversation offline here about our respective businesses as well. And with how many people work remote right now in this hybrid model that's kind of stuck around, probably a little more than most people thought, there's people opting out of their leases and downsizing space. I mean, my financial advisor, he's at a big bank, and they downsized the space dramatically. And they used to have the really sexy office space right downtown. There's people moving out of those places.
The three of us talk all the time, right?
Yes.
We're on our three families text chat. We talk 3 times a week, but I don't think we've updated this conversation, and it's what you're talking about right now, Tom. Coming into quarter 4, coming into quarter 1, the three of us in our respective businesses spent pretty aggressively, knowing that we need to protect market share, protect our agents' ability to have large pipelines going into the spring market. And so we invested. Now, every knowledge broker right now is continuing to invest in their business and grow while others are retreating. It's why I continue to interview every single week more virtual assistants for my business, whether it's marketing, administrative, or just an assistant to help take the things off of my plate that need to be delegated so I can be doing high income producing activities. Myself, Lisa, and Tom all use virtual assistants, and you should too. Use the link down below for VirtueDesk to get $250 off your startup fee with VirtueDesk. I employ a whole bunch of virtual assistants from VirtueDesk. They're the best in the business, and you can get $250 off by using the BAM23 link below. Use the BAM23 code down below to get $250 off your virtual assistant with VirtueDesk. Powell, in his talk, he said it numerous times that the job market will weaken. The job market will weaken. So what he's saying there is recession is coming. Recession is coming. How are you both thinking about the next 3 quarters with spending? And how should agents right now be thinking about their budget for the rest of 2023? Are you continuing to spend, or is it time to pull back again, right? Like last year, there was a moment, quarter 3, pull back, get rid of the fat. Then we started pushing again, coming into when people are in the winter, when people are really hesitant. We knew stacking up for the spring. Now, what's the next 3 quarters look like spending wise?
I think it's going to be, Tom and I were actually kind of chatting about that. Actually, you were in some of it too this morning before you pieced out in the middle of the call.
His wife called. Give him a break. Byron, I got your back here on that one. That's
wow. Tom's finally got my back. Lisa, I knew she would shred me at least once in the first 20 minutes. It took 18. So there you go.
But, one of the things that we were kind of talking about is that I think it's very tough to assess from a high level business owner perspective right now on conversion and profitability, or ROI, if you will, on some of those areas where we doubled, tripled, or in some cases quadrupled down on spend, right? And so I think it's going to be super important to watch it as we make decisions over the next 8 to 12 weeks, maybe. And so what I'm watching is some of those risks that I took, and that I think all 3 of us took, especially with marketing strategies and that kind of stuff. We know that the profitability or the true ROI on it isn't totally there yet. And the question that I'm going to look at is, does it come, right? Is it sitting in the pipeline? And now that inventory is increasing, are we going to see some of the rewards start to come so that we can then start putting cash back in to pad the savings? To the other part of the question, I'm talking to the agents a lot about making sure that they're saving money and putting aside probably 30% more into the savings bucket than they had historically. Understanding that I think sales are I think it's going to be a chilly winter up here in New England in a whole bunch of different ways. But I think November and December are going to be really rough.
They were brutal this year. This last November, December were pretty brutal for a lot of, and then all of a sudden people had short have short memories right now, because January and February was like, oh, especially during those months where we had the low, or those weeks rather, where we had the low 6% interest rate. When we were talking about conversion, and certainly everybody listening, you can definitely leave a comment. By the way, if you're enjoying Knowledge Brokers podcast, please consider subscribing to the channel. It'd help us out a lot. But for the conversion conversation, are we going to start thinking about lead conversion differently? Where if you work Zillow leads, there's a certain conversion number, or if you're working RDC, Realtor.com, or if you're pay per click, you might have a different conversion number on different lead sources. Lisa, if a lead ends up in 2-3 different places, Z, RDC, somewhere else,
Google.
Is it about just having the biggest pipeline at a lower cost per lead, or a lower CAC, than it is necessarily having this amazing conversion score?
Yeah, because the conversion score matters for some, right? And we know this at some level, right?
It definitely matters if you only have 10 leads, but if you have an enormous amount of leads, if you own lead arbitrage, does conversion score matter as much as those other variables?
I don't necessarily think so, unless the arbitrage is tied to the conversion metric, right?
Yep.
If you're running one of those large flex accounts and you risk losing the size and losing the market share, which creates part of the arbitrage. So I think that it's a delicate balance, but I think that, one of the strategies that we kind of took is, and I say it openly, I wanted to own all the leads to help us grow the company as a whole. Right. And so if that's a strategy that we took, I'm kind of taking a little bit of a step back on conversion, because the ultimate growth of the organization is more important than the conversion in the short term. Bit of a loss to take a bit of a J curve, right? Dropping down on
Yes.
the conversion and dropping down maybe a little bit on the profitability of the company, in order to be able to put us into a position where 6 months from now, we're going to have had really great growth. And I think all three of us kind of took that strategy a bit.
We did, and dropping down the conversion at a time when conversion's likely going to drop anyway, seasonality.
Yep.
And inventory.
Yep. And I think one of the keys, and I think that this is beneficial for every single agent, team leader, broker owner, is understanding where some of the gaps came and being able to have a strategy in place to go back and catch them afterwards, right? Because what I also know, and I think all of you guys know, is just because the lead inbounded in, say, February, doesn't mean it's going to transact February, March, April, and there's still an opportunity to go back and save it and reconvert it later and build it back into your pipeline.
Well, that's a really great point, because you go through your, you audit databases, right? So do I. You go through these things. It's, the 2-3 calls, the first month the lead comes in, that lead could be nowhere near being ready. They could be in that voyeur phase. They could say, oh, well, look at this Fed meeting, or rates went up. I don't know what I'm going to do. And it's that constant, hey, who am I going to trust? Who's the knowledge broker, right? Who's going to be the person that ends up giving me the information I need, so I feel certain about spending the money that I'm going to spend to get into a house or selling my asset? And if that relationship isn't built, this is the difference between 2020 to halfway through last year and right now, is that Byron, you said, NAR, they just added over 1 million sides to their projections, right? That's 1 million more deals anybody could do. And there's going to be competition for those. And odds are, the average internet lead, it inbounds, I think the stats are like 12 times as a new lead before someone actually converts it. Or, they're not, whatever the number is, they're not just talking to one agent. It's not just Lisa Chinatti leads or Byron Lazine leads. They're talking to multiple people. So understanding, hey, here's where rates are going. Here's what's happening. Here's the projections. Hey, you might want to wait when rates were at 7. Byron, we had that conversation right on this podcast, telling people that that's who's going to be the person that gets their unfair share of business in the current climate.
Well, saying it's always a good time to buy when on a Monday you could be at 7, and on a Friday in any given week you could be at 6. It's a little hairy of a position today. Now, and we've talked about this in the pod with really understanding the mortgage products better than ever right now is an advantage as an agent, because you put your clients in a position to save money. And then just talking to them about the long term. I shared this chart with both of you guys. And Cooper, if we could take a timestamp here and just put this up, the home price growth by months into the decade, seasonally adjusted Case-Shiller National Home Price Index. Lance Lambert put this together from Fortune. It shows you here the last 4 decades. And so the fear and uncertainty that these internet leads, or any type of home buyer lead, especially a first-time buyer, because their uncle told them it's a bad time to buy. And I would agree that there have been better days to buy in 2023 than others. If you're just riding the average interest rate and you don't have a specific product that's buying down. And you've got to really work with the knowledge broker, the professional, to put you in a best position right now to take advantage of this market with low inventory and volatile interest rates. But when we take a step back and really make sure that that buyer, that lead, understands the long-term advantages to home ownership, the 1990s had 30.2% home price growth. The 2000s had 48.2%. And so every millennial or Gen Z buying right now that you're advising, when they talk about, well, 2008 is going to happen again. Yeah, well, do you know from 2000 to 2009, homeowners actually gained almost 50% equity? Yeah, for a couple years, it was over 80%. And then it cooled off during the great financial crisis, which is unlike anything we're living through today. So that decade, they gained 50%. They followed up the next decade, by the way, the 2010s, homeowners with 44.5% home price growth. And so far in the 2020s, we're at 39%. So if we're looking at a 10-year plan of home ownership, you're in a situation where you're going to get, likely 40% on your money. If you put the 1 to 2%, here's a big takeaway and something that agents should be talking about with their buyers more, is if you put the 1 to 2% back into your home every year. If you've got a home that's worth $300,000, you should be putting $3,000 to $6,000 back into the home of general maintenance, because you don't want that call as the listing agent in 10 years and they put $0 into it, and then you have to have that conversation of, okay, you need $30,000 or $40,000 worth of work just to bring your home up to the standard, right? Because you didn't maintain the home throughout the year. Helping them understand that part of home ownership too is just as valuable as what you're going to naturally get on the growth curve of home price appreciation.
Well, and I in this kind of market, I've said this before, you got to have some like recession power rules for your business. First one is motivation matters. I mean, that is number one in any of these, because we've all transacted folks that they hear the data, they understand what's going on, they get the risks, and they say, hey, we're going to pull the trigger regardless of the conditions, because they have a life event that's going on. And that's where nurturing leads, looking at a longer view of your funnel and realizing, hey, maybe it's not even a 90-day lead time anymore. Maybe it's 6 months is what I got to be focused on. Maybe it's a year. Someone tells you they're moving in a year and they got a home to sell. You better believe it. I'm following up with that person every couple of months, letting them know what's going on. And that's a skill that went by the wayside after the pandemic until, I would still argue right now, but at least people are starting to think that way.
A rule of thumb, if somebody says they're going to make a move, make a sale in a year, you always cut that in half. That means 6 months is likely when they're going to do it. And so to Tom's point about I'm following up every month, every 2 months, if someone's going to list in 6 months, you want to be in communication throughout the entire process of the next 6 months, because in 3 months, it's pretty easy to forget who you even are if you haven't spoken to them.
100%. I think also from the seller perspective, one of the things we're talking about is going back, and it falls right within that 6-month period, is the folks that had started expressing interest about selling in August and September, and then got really spooked by everything that happened with rates in October. And I think that for the folks who have the knowledge and the ability to have really consultative conversations about the realities of the market, I think that there's going to be a lot of opportunity heading into the spring market with the folks who were giving it thought in August and September.
And Lisa, are you finding that those homeowners in August, September who got spooked because their they're paying that much attention. Like if you got spooked in August and September, you're paying more attention than the average homeowner to economic conditions. When they come back right now, what I'm seeing is that the price in their head in a lot of markets that have this low inventory across the country, we're at about 3.5 months of inventory, but the Northeast, for example, is 2 months. And let us know in the comments what months of inventory is in your market and which market that would be. But they may be coming back to you with a price that's below what they could actually net. So they're actually coming, if they're watching that closely to economic conditions, they're probably more conservative on price. And it's a delightful surprise that, it's not $799. It's $850
Right.
on your house. That's a scenario with a past client of mine. I just had the discussion. He's like, I think we can get 8. What do you think? I said, I know you can get $850. And I think if we list it right there, we might find out that you have enough demand for maybe even a little more.
Yeah, no, same thing. We actually, case in point, we had a seller that had listed with another agent in September, pulled it off in November because they got spooked about where things were. When he pulled it off, it had been listed at 910. We put it back on at 975 and got over $1 million for a house that was just kind of sitting with nothing going on just a couple of months ago, right? So it exists.
It exists. And to Lisa's point earlier in the pod, that think about that. Just 6 months ago, a home listed at 910 was sitting, and then now listed at 975, sold over $1 million. It shows you that how quickly this market can change again, because we can go back to that scenario in quarter 3, quarter 4 this year. I think we all have a feel of what quarter 2 is going to look like, but to predict quarter 3, quarter 4 for your business or for your clients, it's going to be a really rocky place to try to make a prediction. And we could certainly see a slower market. So saving money, like Lisa said, and advising your clients on the urgency of today being a seller is the power position, showing them what the last 6 months of last year looked like. And if you wait too long in the spring, you could be in that quarter 3 bucket where we just don't know what it's going to look like for the certainty of your sale.
Well, to that point, right? So the housing market tracker said we saw a little bit of a spike in inventory this past week. Not much, and
a little 1,700.
You know what?
Homes?
I'm taking anything positive right now. Like I said, I'm positive.
I agree.
Pete. So I liken that though to, if you remember during the shutdowns and everything else, Showing Time had that chart of showing activity, and you guys were able to go out, sell houses. We were under a fascist lockdown in Pennsylvania, thanks to our lovely governor. And literally, like days before, there was rumors of an announcement, like, hey, I'm finally going to pull my head out of my ass and make real estate essential, is kind of what happened. And I'm being nice here, by the way. But we saw that showing activity blip up just a little bit. And it was that first positive move. And my hope is that we'll see the same numbers this week. My hope is we saw a bottom with inventory. It bottomed out right around this time last year nationally. So I would encourage everyone to look at their local data. I pulled ours. Lisa, I know you've been tracking this. So in the Bright MLS in the 5-county area outside Philadelphia, so it's Bucks, Chester, Montgomery, Delaware, and the city, the previous week, so the week of the up until last Thursday, so it's like the 9th to the 16th or whatever the date was, we saw 562 homes go coming soon or newly active to the market. This week, we saw over 1,000. So that's a big jump. Now, obviously, I will disclaimer this, that Philadelphia and the city is a very different market than the suburban markets. I think that's kind of across the board in a lot of places. It's obviously super local. If that continues, and I'm not saying we don't need a ton of inventory right now, just a little more inventory would go a long way for some of these people that are out there, and that might help strengthen the market that Jerome Powell thinks is weak right now.
Who do you think's stronger, Jerome Powell or Janet Yellen in a push-up competition?
I don't know. That's
girl power.
Girl power. Janet is Janet. Oh, can you say Janet Yellen's a female? Would you say that?
Are you allowed to even say
with
anyone's
confidence?
a female in today's world? I think that's the better question. We have to ask them.
Here we go. Episode 12, Knowledge Brokers
canceled.
officially has been canceled. Yeah. Of course, Lisa plays at PC and just that says nothing on that.
What do you guys think about inventory? Did we reach a bottom? Like, I mean, I'm
Lisa. Hold on. For everybody watching or listening to the pod right now that loves Lisa, she is the most politically correct person, and it's nonsense. It is. I want everyone to know it is nonsense. Okay. This is not the true. This is the true Lisa, but she always plays it safe.
I walk the line. How about that? I walk the line.
All right. Yeah. Final thoughts heading into this weekend and into this week.
I think we've bottomed out inventory. I think this is the start of some really big movement forward. And I'm actually, like I was saying it to you guys this morning, I am more excited than ever for where we're going to go over the next 8 weeks. I think that there's massive, massive opportunity for those that are ready, willing, and able to take advantage of it.
I'll leave you something to think about, and maybe we pick it up next week or in the coming weeks. It's not a great thing for home values, but I think it would help. It will help inventory when it happens. And I'd be curious to know if you see this coming in your market. The increase in property taxes could spur some people to make that move they've been thinking about, because I think that increase in property taxes in a lot of municipalities is coming.
That's an interesting topic because it varies so much state to state, county to county.
It does.
And I mean, we can jump into I'd love to unpack this a lot, like how it works in even our local markets, because it differs from the city of Philadelphia to Delaware County to Chester County. And these are all places that touch each other.
In Connecticut, there's a lot of these assessments that are happening. Obviously, in Florida, where I live, we're locked into a property tax structure where it's never a conversation. If you're homesteaded, you know exactly what your taxes are going to be, the next year. But it's a huge conversation in Texas, where they're seeing real big increases with the property value increases, and they have high property taxes there. So I think that could help inventory. But generally speaking, I'll agree. Inventory bottom. Tom, what say you on that?
I'm a positive Pete. I'm looking at the local data here. I mean, that's it's really what the market needs right now. I mean, let's be realistic. I mean, there is frustration. There is fear in the marketplace right now. And anyone that's running away from that or hiding in the sand and not taking it on head on and charging is going to be making a mistake, whether it's a consumer or it's a professional within the industry. So let's all hope we're right next week. When that thing comes out Monday, sure as hell I'm going to be texting you guys. Let's see how the housing tracker looks with our boy Logan. And let's hope he's right too, because he's optimistic that that's the direction this is going as well.
And we need new listing numbers to go up. So knowledge brokers out there, go get the new listings and encourage early spring sellers. You're going to be doing them a favor as opposed to being a late spring seller. All right. Until next week, guys. Appreciate it. This was fun. If you guys are having fun enjoying this, please share it with somebody and consider subscribing. That way Lisa doesn't quit on us. Lisa said if we don't get 1,000 subs in the next 14 days, she's quitting.
1,000? I think I had said like 2,000, but
all right,
you want to aim small.
She's one of the negotiators. When you get a deal, she's like, I changed my mind. It's 2,000. I don't know.
I could have said 10 and she would have said 20.
Yeah,
it would have been
point.
Whatever. I could have said 100,000. It would have been 200,000. This is Lisa Chinatti, folks, the true knowledge broker.
Get your knowledge.
See you guys.